Let me do this quickly. Guys, so first column. If an asset was acquired from a vendor, an input VAT was claimed on acquisition, output VAT levied on the sale. So I buy goods, I claim inputs. I sell the goods, I charge. Second type, if an asset was acquired new from a non-vendor, no input VAT could be claimed. So notional input VAT is only claimed when you buy second-hand goods from a non-vendor. This is new goods. Can't claim input VAT. The rule is output VAT will still be levied on the disposal of the asset. So looking at the illustration here, new trading stock bought from a vendor for 300,000, just below it. No input VAT claimed, as there was no VAT invoice. If we sell it for 399, you've got to charge output VAT. Guys, comfortable? Next one. It says if an asset was acquired that was used for the purpose of exempt supplies, there would be no levied VAT in the disposal of the asset, as the disposal would be an exempt supply. So let's imagine that there's residential accommodation. What happens with residential accommodation? It's exempt. So if I buy a bed for the house, what happens? It's exempt. I can't claim it. What happens when I sell the bed? I'm not a VAT vendor with the house. Therefore, when I supply the bed, I don't charge VAT because I'm not registered as a VAT vendor. So sometimes when I don't claim, I don't charge. But sometimes when I don't claim, I do charge. So if it's exempt, guys, an educational institution providing exempt supplies, buys classroom equipment in the example, in the middle, for 345, no input VAT is claimed as the equipment used for the purpose of providing education. Okay? What happens if we sell the equipment? It's sold for 300, no output VAT will be levied. And the reason is, I'm in the business of making exempt supplies. Therefore, I don't charge. Next one, guys. It says if an asset was acquired prior to the VAT legislation being introduced in September 1991, no input VAT would have been claimed when an asset was acquired, as there was no VAT legislation. And I've got the output VAT is levied when this asset is disposed of. So guys, if I bought something before VAT legislation was enacted, I charge VAT when I sell it. Is that all right? So looking at the example just down below it, it says the building was acquired in 1985. No VAT input was claimed as VAT legislation had not been introduced. When the asset is sold, output VAT will be levied on the sale of the building. Input VAT can never be claimed on the acquisition of this building, even though output VAT is still levied on the sale. Tough shit. So basically what they did, they had a snooze, you lose policy with items. You didn't claim VAT, tough shit for you. When you sell it, we still want our VAT back. It's good to be the king. Yep. Sure, no problem, because it's a VATable transaction. Transaction takes place in 2020. But in 1985, when you bought the building, there was GST. No VAT when you bought it, therefore, couldn't claim anything. So, didn't claim input, but still charge output. So I've shown you 2 times where, even though you don't claim input, you're supposed to charge output. Are you guys comfortable? And these are normally asked as little 1 or 2 markers in an exam. You'll see that they often actually just give you the stuff, because they give you the exception to the rule to see whether you know the exception to the rule itself. There's another hand up here. Yeah. 91. Yeah. It was 30th of August, 91, I think. Somewhere around about there. Okay. And then the last column, guys. So it says, Section 814 of the Act states that when input VAT has been denied by Section 17.2, subscriptions, motor cars, and entertainment. So guys, that's professional membership subscriptions, huh? Not professional, sorry, sporting. Guys, no output VAT needs to be levied in terms of the asset that is disposed of. So basically, no input, VAT denied, no output when we sell it. You guys comfortable? So guys, if you're looking at where the output should be charged, I've basically got normal transactions, you levy output. Buy new goods from a non-vendor, you charge output. Okay? You buy it under the GST legislation, you charge output. The only 2 times you don't charge output is where input VAT was denied, motor car entertainment, membership subscription, or where you in the business of providing exempt supplies. Are you guys comfortable with that? Does that make sense, guys? Is that cool? Now, I'm going to do apportionments of that after the break in a lot of detail. So I'm going to come back to stuff like this, and I'm going to do organizations that do part exempt and part Vatable. Are you guys comfortable with that? Okay. So you guys comfortable with this one? So guys, there's an illustration. Let's just make sure that you know how to do this. So number one, it says sale of a motor car for 171. The company was denied input VAT in the buying of the car. The car was sold for 115. So what do you think, guys? Should we charge output? No. Machine XYZ acquired for 2283 years ago. 28,000 input VAT was claimed. The machine was sold for 171. Do we need to charge that? Yes, and we charge it at 15, even though we claimed inputs at 14, huh? You guys comfortable? The fact that there's a change in percentage doesn't affect what you charge. Okay. A computer mainframe was acquired for 228, including VAT. It was used for running the ledger for the residential letting division. No input VAT was claimed, as the computer was used for residential letting, which is an exempt supply. Sold for 34,200. Guys, so here's an important thing. Don't look at what the asset is. Look what it's used for. So because it's used for residential letting, which is exempt, you don't need to charge the VAT. Guys, comfortable with that? Next one. It says a coffee machine was purchased for use by staff in the staff kitchen, costing 3,000. Now, guys, if you use stuff in a staff kitchen, that's the provision of entertainment to staff members. Input VAT denied. Therefore, what happens when you sell the coffee machine? No output VAT charged. Next one. It says a building bought in 1983 for 300. Immediately, you know that there's no VAT because it was GST legislation. What happens when we sell the building? Charge VAT. And then machine bought new from a non-vendor for 150. No VAT input claimed as there was no VAT invoice. Machine sold for 90. Charge VAT. Guys comfortable with this? Guys happy with this? Okay. So that's there. Next section, guys. Importation of goods. Okay. Now, normally I give you a little bit of time to write something down because I find that people don't understand why the section works like it works. So let me just give you an example. Let's imagine that I'm really hungry and I want to actually buy a bar one, but I happen to be standing on the border between South Africa and Zimbabwe. And I kind of like, you know, in Zimbabwe they don't want some dollars, they want rands. So I kind of like look at the oak that's on the South African border and I say, how much is a bar one? And he says 10 Rand plus VAT, 11 Rand 50. And I look at the oak on the Zim side, he says, shit, I don't need to charge VAT, I'll give it to you for 10 bucks. Do you understand that the foreigner's got an unfair competitive advantage on you? So if I go and I buy the bar one in Zimbabwe and I eat it there, no problem. Okay? If I walk across the border with it, what does border control do? I say, I want my VAT. So that there's a comparable thing. Does everybody understand? So who actually issues like a VAT invoice to you? SARS does, at the border post. The customs duty agent will issue you with a VAT invoice. Because the foreign oak can't charge you VAT. Does everybody understand that? Because he's not registered in South Africa. But the oak at the border will issue you with a VAT invoice. And then what will you do in your VAT return? You'll claim the input. But that's just to make sure that South African businesses remain competitive. Otherwise, you're always going to buy the bar one from Zimbabwe rather than from inside South Africa. Are you guys comfortable with that as a logic? Okay. So if you have a look at the table here, there's two blocks, imports from BSLN countries and imports of goods from non-BSLN countries. So BSLN, Botswana, Swaziland, Lesotho, Namibia. Now guys, this is like a common rand monetary area. Plus what happens is there's no customs duty when you move goods in between these areas. So Botswana, Swaziland, Lesotho, Namibia. No customs duty. So if you look on this side where it's non-BSLN, what happens to the calculation? I've got customs duty value, I've got customs duty, non-rebated customs duty. Why? Because non-BSLN has got customs duty. Because there's no customs duty, we don't need to take that into account, guys. Are you guys comfortable with this? Okay. So value of supply, what do? Output VAT is charged at 15% of the customs duty value. So you're bringing it in, they say, no customs duty is going to get paid, but we want our VAT. That bar one, you have to pay VAT on. Are you guys comfortable with that? Now, if you're importing from, say, America, okay, so from the US, it's customs duty value plus 10% of customs duty value plus non-rebated customs duty plus other import surcharges gives you an importation value times 15%. Now, guys, for both of these, we're timesing by 15%, not by 15 over 115. Why do you think we're timesing by 15%? Because the amount excludes VAT. Is that all right? No VAT's been charged on it, so we've got to times it by 15%. Are you guys comfortable with this? Time of supply, guys? Essentially when they're released in terms of the Customs and Excise Act, so when they come through customs. Are you guys comfortable with that? Okay? And then, guys, example. It says goods with a customs duty value of 100 were imported from Namibia. So what's your VAT? 15% times 100,000. Okay? On the other side, it says goods with a customs value of 200 were imported from Brazil. Customs duty and import surcharges of 40 were charged. So what do? You say it's customs duty value plus 10% of customs duty value, 10% of 200, which is 20, plus the non-rebated costs, 40. And that whole amount gets added together and you times that by 15%. Are you guys comfortable with that? Okay. Now, guys, this can cause a little bit of trouble in exams, and I'm just going to go through, and I just want to discuss the two problems with you. Guys, please, it's what the value is when it's in customs. Is that all right? So for accounts, what you normally do is you normally do an FOB. So risk and rewards of ownership change, FOB, when it gets put on the ship. Do you understand that customs will see what the value of the goods is when they're in their possession? So they're not going to sit there and say when the goods got put on the ship, the exchange rate was 8, and I'm going to use that. What are they going to do? They'll use the exchange rate that's ruling when they release it from customs to work out a value. Does everybody understand that? So there's a slight difference between accounts and tax. I'm going to show you now. Second thing is a bonded warehouse. What is a bonded warehouse? So I don't want all of the TVs now. So I'm macro. Okay, I think the rand is going to go for a ball of shit when we get downgraded. So I decide that I'm going to buy 10,000 TVs, but I don't have 10,000 TV space in my shops around the country. So what I do is I shove it into a bonded warehouse. Are you guys comfortable? And when do I get charged customs duty? Only when they come out of the bonded warehouse. Does everybody understand that? But there's a special rule for that as well, which I'm going to show you now. Okay, so I've got there at the bottom of this, and underneath the two blocks. It says, note if goods are stored in a bonded warehouse, input VAT only needs to be paid when they're removed from that warehouse, using the greater of the amount that you calculated, or open market value at that time. So if it's gone up in value, just understand you're going to pay more VAT, which you don't really care about if you macro, because you're going to claim input VAT anyway. Does that make sense? So it's not really an issue if it goes up. Are you guys comfortable with this? Okay. So let's look at the illustrations. So first one. So Sinostar is an SA company registered as a VAT vendor. The company imported the following shipments. Shipment 1 from the United States, customs duty 50, customs duty and import surcharges are 60, calculate output. So what do? We say 500, customs duty value plus. Is it coming BSLN or other? Other. So plus 10% of 500 plus the 60 gives you 610. Input VAT 15% times by that amount. Guys, comfortable with that? Second one, shipment 2 is from Namibia. Customs duty value is 200. So what's VAT going to be? 200,000 times 15% because it's a BSLN country. Next example. Import is always times 15, yeah. Guys, now this is the one that I discussed with you that causes some trouble in exams. So it says goods are imported from the United States. The good costs $20,000 and a place in a ship FOB when the exchange rate is $1 equals 8. So for FINAC, you're going to be recording it at that. For tax, you're going to be recording it at that as well when we do Forex. Are you guys comfortable? But customs is not income tax and it's not VAT. Okay, customs deals with the VAT when it comes in. So it says there, the goods reach customs when the exchange rate is $1 equals 9. Import surcharges are 2,000. So when we work out customs duty value, it's what it's worth in customs at that point in time. So $20,000 times 9's the exchange rate, 180. Okay, plus 10% plus import surcharges gives me 200 and 15% of that. Are you guys comfortable with that? I've seen them do it in exams. It actually does cause stress because you do the income tax at 160 and you do the VAT at 180. But the VAT is a non-entity for income tax because it's output paid, input claimed. Are you guys comfortable with that? So they like to integrate that together. When they ask VAT and income tax together, you've got different rates that you use. Next one. It says goods are imported by a VAT vendor and output VAT of 10,000 is charged at the point of entry. The vendor pays 10,000 VAT outputs upon clearing customs. What will the VAT implications be if this was imported by a vendor who used the goods for making taxable supplies? I paid output when at customs. I get to claim it in my next VAT return. Are you guys comfortable? That is your VAT invoice. What SARS does, I can claim in my VAT return. So I end up in a net zero position. Is that all right? But they're interested in you and me that import something that there's no VAT. So when you get off a plane, they normally ask you to make a declaration that you haven't stuffed your bag full of shit. Okay? And what happens if they find stuff that you've bought overseas? They're going to charge you VAT when you bring it back across. Are you guys comfortable? By the way, just one thing. If you're taking a computer overseas, just go and get a SARS declaration at the airport. So I know lots of people that kind of like all in a fluster. You know, you've got SARS officials on before you go through. Go and actually say, this is my computer, I'm taking it with me overseas. Because if they see you carrying a computer bag off a plane, they will ask you for the declaration. And then if you don't have it, you've got to go find the original invoice with the serial number on it. Otherwise, you have to pay the VAT. And they will keep your computer at the airport if you don't want to pay it. And do you understand? Do you understand why I'm saying that? So just to be on the safe side, anything that's expensive, go and just get a declaration before you decide to actually go through. Is that okay? And they have no choice. They will do that. Are you guys comfortable? So in Australia, they're worried about fruit, and we worried about... No, don't worry. Never mind. Guys, comfortable? And then the last one, guys. I don't think you'll get a bonded warehouse, but just let me show you what happens here. So, guys, effectively this example, and I don't need you to read through it. We do our normal calc for import duty. Does everybody understand? But what happens is we also look to see what the market value of the goods is when we take it out of the bonded warehouse. Is that okay? So in this case, you'll see that the calc is 370 times 15%. But the market value of the goods when they come out of the bonded warehouse is 380. So what we do with the bonded warehouse, it's the normal calc, or the market value of the goods, whichever is higher, and we're going to pay VAT on that. So you'll see in this example, we're going to base it on 380 because the goods have gone up in value. And again, please don't worry about it. From a tax planning perspective, you get the VAT back anyway if you're a business. So you couldn't give a shit if it goes up. You just rather delay the VAT payment because rather have the money in your bank account rather than in SARS's bank account. Does that make sense? Or in the olden days when there was like the old Nat governments, guys couldn't get stuff. So like at ACI, I used to do the audit there. They bought wax for the next 25 years for their explosives because they didn't know whether they were going to be able to import wax again. So they had this huge bonded warehouse filled with wax. And 5 years later, the ANC came into power, and they had like 25 years worth of wax stored in a bonded warehouse, which incidentally was on their premises. So sometimes a bonded warehouse can actually even be on your premises. And then you notify as you take stuff out of the bonded warehouse. Guys, comfortable? Okay. Now, imported services. Now, this one is going to be a little bit more complex. So, can I just ask you to just listen? And if you want to write something down, write something down. Guys, an imported service by its nature is not going to go across a border. Okay, so let me just give you an example. Okay. So during the World Cup, I got called in to actually do a little bit of consulting on what Mnet should do with their signals. So their own guys were actually filming the Soccer World Cup. They were in turn selling it to international guys. International guys in turn were selling it back to South African guys. So Mnet was buying their own product back. Do you guys understand? So the question was, what do we need to do from a VAT perspective? So here's how it works, guys. Let's imagine that bar 1 again, okay? I buy it for R5 in Zim. As I walk across the border, what do? charge me 70 cents, yes, 75 cents VAT, sorry. And then what do? I claim the 75 cents VAT in my VAT return. So what is my net effect if I'm a VAT vendor? Zero. Do you understand? Whatever I pay to SARS, I claim back in my VAT return. My net cash flow is zero. So what they say is when there's an imported service, and can you see it says services imported by 100% VAT vendor. The rule for that is we know you're going to be in a zero position anyway. Therefore, what? Don't worry about it. Is that okay? So we know you're going to be in a zero position. So the latest Game of Thrones episode, what do you think Mnet does where before they showed it? HBO word, make it available for download. They download it. No border. Do you understand? But because Mnet is a VATable, they charge you VAT on the subscription, Mnet doesn't worry about it. There's no VAT that needs to be done. Does everybody understand that? However, if you decide to have an Apple Store account, but you like the American store because the music's nicer on that store, and you decide to import a service, because think about it, if you buy a song, that is an imported service, because it's not a good, it's a service. You technically are supposed to go to SARS and say, listen, I bought the new Billie Eilish song. Okay, I bought it for $1, so can I fill out the VAT return and can I please pay the VAT across to you? Technically speaking, although there's a limit. If it's below 150 bucks, you don't need to go and do that. But technically, you're required to do it. So that's what the second box is. It says if services are imported by a non-vendor, no input VAT can be made. Okay, if SARS collects outputs on imports and does not have to pay input VAT, this will be a positive source of cash flow for SARS. Do you understand? So if there was VAT, SARS would charge output VAT, not have to pay you back anything. So because SARS is short of cash, what do they ask you to do? If you import a service and it's not for VATable supplies, they ask you to fill out a return and go declare it. Are you guys comfortable within 30 days? Okay, so I think it's a little bit easier if you see one or two examples. So let's just go to examples. I want to just do this one first. Not that one. Okay, sorry, no. Sorry, the first one is right now, sorry. So it says, Mnet bought the latest series of My Wife's Ex-Girlfriend is Hot, a popular TV series from Fox Studios in America, paying $1 million to use it. The series is downloaded by them or Fox Studios website after an appropriate password is given. In addition, they download 30,000 rands worth of music from a website that will be used to play to staff and customers in their buildings. Okay, so guys, the TV program, what is it used for? No, but you're in the business of providing entertainment, so you can still claim that. So guys, I'm selling subscriptions. Do all of the subscription guys actually pay VAT across to me when I sell subscriptions? Yes. So what do I do with this? I do nothing, because whatever outputs I would have paid, I would have claimed as input. So they say, when it's a service, don't bother us. We don't know that you've done this, but we don't need to know, because we know we're going to be in a zero cash flow position anyway, so ignore it. It says, now the music that's used to play to their customers, is that entertainment? Can you claim VAT on entertainment? So what is Mnet required to do? The 30,000, they're supposed to, within 30 days, go to SARS, fill out the required form. So we spent 30,000 rand on music for use, but we downloaded it. It came across the border, but it was a service that came across the border. And they're supposed to pay the VAT on that. Does that make sense, guys? Because SARS would have collected money from that. They would have charged at the border post, and you wouldn't have been able to get it back. So only on stuff that you wouldn't have been able to get back are you allowed to charge. So here's a solution. You'll see 30,000 times 15 over 115 in the second paragraph. And don't worry about anything in the first one. Just ignore it. Are you guys comfortable? Next illustration. It says, service agreement 1 was for services rendered by a Russian company that provided advice costing 120 as regards sale of goods. Calculate output VAT. Nothing. Sale of goods is VATable. So I would have charged and claimed. I would have been in a null position. It's VATable, so I do nothing with the service. So service agreements used for services rendered by a Hungarian company that provided advice costing 175 to an educational institution within the group that was exempt from VAT. Guys, that is VATable. Because I couldn't claim it because it's an exempt supply. If they providing the services through into South Africa, I need to pay outputs on it. So that's the one where I've got to go to SARS and say, can I fill out a return? And then guys, the third one, I haven't got in the theory, but it can pop up in an exam. It says service agreement 3 was for services rendered by a Hungarian company that provided advice costing 228 to a property division within the group that had agreed inputs, apportionment percentage of 70% taxable supply. So what we're saying is that business is 70% VAT and 30% not VAT. So how much do you think the VAT is that you need to account for here? Just the 30. The 70 we ignore because it's VATable. But the 30% that we weren't going to be able to claim as input, what are they asking you to do? Pay it across to them as output. Are you guys comfortable with this? Does that make sense? So importation of services, guys, just again, if you are VATable and it's for VATable supplies, do nothing. Where it's either exempt or partially exempt, you need to pay the VAT on the exempt portion across to SARS. Yeah. You're not claiming. It's actually an output, so you're paying an output across. SARS wants to be in the same cash flow position.
So output tax is applicable provided it's not.
Yeah. Is that right? So it's output tax. So even though you're buying, what happens? There's output tax. Because if you had to pay 100% and claim 70, what would be left over? 30. So what did they say? To bypass everything, just pay the 30. Are you guys comfortable? So this is where you've got an output even though you're buying. There are 3 instances in the Act. This is one of the 3. So there's output even though you're the buyer. Are you guys comfortable? Happy? So that's imported services. Okay, let's carry on. Next one, exports. So, 3 blocks. So let me just explain what's in the 3 box. For direct exports, guys, that's when you take it across the border. Do you know that it's gone across the border? So you can zero rate immediately. Are you guys comfortable? I'm going to go back into the 3 blocks. Indirect exports, I'm not taking across the border. I give it to a company to take across the border. General rule is zero rated now, but they've got 3 months to give you back the proof that it went across the border. If they don't give you back the proof, you account for that 3 months later. And then exports of secondhand goods, guys, there's special rules when you buy secondhand goods from a non-vendor. So there's special rules when you export them. Are you guys comfortable? So let's do the first block first. So it says where direct exports are made by a vendor and the selling enterprise actually transports the goods overseas personally, the sale is zero rated. Are you guys comfortable with this? I'll just zero rate. It's cool. Indirect exports. Consider the situation where a non-resident acquires goods in SA from an SA vendor. The non-resident wants to take the goods overseas personally. As the seller does not know whether the goods are in fact exported, VAT must be charged on the sale of goods in South Africa. So guys, essentially, if the person is sitting there at a shop in Sandton City and they go, oh, I love that. And then you say it's 100,000 plus VAT, 15,000 Rand extra. Says, no, but I'm a foreigner, I'm going to take it across the border. You say, here's the invoice. You go to that VAT department at the airport before you go, when you go through customs, and you claim the VAT back there. So you pay me 115, you can get the 15 back when you show them you've taken the good back across. Are you guys comfortable? Or if you give it to someone to take across the border for them, you can zero rate it provided you get the proof within 3 months. Is that all right, guys? Does this make sense to you? Okay. Let me just use the third one. Yeah. They can give you cash back, yeah. Yeah, they sometimes give you a credit card, you can get a transfer back. They do all sorts of things. They might do an EFT. You must always do it when you come through, when you're overseas, because you can claim the VAT back when you're overseas. It's the same rule if you're bringing stuff back to South Africa. You can go claim the VAT back. There's only one problem with doing it overseas. It's a little bit painful, because like there's different rates of VAT in the European Union. Normally you can only claim it back at your last port of exit. So like we went to Czech Republic where VAT was like 17%, and then the UK where it was 10. And unfortunately, because we were going back out through the UK, we couldn't claim all 17% back. They only gave us the 10%. Although that won't be a problem with Brexit now. So you'll get to claim it when you leave the Czech Republic now. Are you guys comfortable with that? So, you guys comfortable? Can I just show you export of secondhand goods from a non-vendor? And I just want to just do a little example with you. So this actually happened. I actually got asked to consult on this. So there was a motor car enthusiast. So basically he used to like trade in old cars, and houses just for divine providence. So he breaks down on the way, like just near Sedgefields in the garden route, and his car breaks down and his cell phone's out of battery. So he wanders into this house, okay, and he can't believe his eyes. There's a car that he's been looking for the last 20 years, and it happens to actually be sitting there in the grass. The oak hasn't driven it for like 30 or 35 years. So what happened was there was a Ford Thunderbird that they made 2 right-hand drives in the world. And because it was so popular in America, they never ever ended up exporting it to right-hand drive countries. So one went to Australia, one came to South Africa just as a display model. The Australian one sunk on a ship. So this was the only right-hand drive of its kind in the world. So he looks at the oak, he said, "What do you want for the car?" I mean, the oak says, like, if I would just take it away for free. He says, "I'll give you 5,000 Rand for it." And the oak thought it was the luckiest day of his life. He came to it. He ended up selling it for just over 1 million Australian dollars to a collector. Okay, so he came to me and said, "So what's the VAT? Do I need to charge VAT?" Now, it's an export, yes? So what happens normally with exports? They're zero rated. So I said, this is the way that it works. When you buy a second-hand good from a non-vendor, you claim notional input VAT, which would be 5,000 Rand times 15 over 115. Guys comfortable? When you export a second-hand good, what SARS says is, I want the money back. Does that make sense? So SARS says, it's zero rated, but I want money back because I want to be put into a zero position. And that's what happened. So he had to pay the VAT back. Okay. And the oak, I hope the oak never ever finds out what he actually sold. Because at that stage, it was about 8 Rand to the Aussie dollar. So it was about 8.2 million Rand that the car got sold for. So yeah, imagine, so you've got, it's like that oak that sold that Fabergé egg in the UK 3 years ago. I don't know if there's one of the Fabergé eggs. His grandmother brought it from Russia, and he found out she used to work for the Tsar. And he thought it was worth nothing, and he sold it on a jumble sale. He got £5 for it, and it was worth 400 million euros. So that's a bit worse, though, because the guy looked at it. There were rubies all over it. So yeah, I know. It was sold for 400 million euros, for 430 million euros to a collector. So, are you guys comfortable with this? So you got the 3 things there. So let's just go to the example section. Okay. So basic application of exports. It says A Limited sells machines and have 2 invoices to process. An invoice to a local purchaser for 10,000 excluding VAT. So I charge VAT to a local person at 15%. And an invoice to an overseas purchaser for 20,000 ex VAT. Guys? Zero rated. Guys comfortable. 15.2. They like to ask these as journal entry corrections. So it says, a client passed the following journal entry for the exports of goods to the USA. The client agreed to pay 57.5 for the goods to be supplied, which would be an indirect export. The company delivered the goods overseas and provided the company with proof that the goods were exported. So the journal entry that was passed was debit receivables 57.5, debit sales 50, credit sales, credit output VAT. What are you supposed to do if it was an export? Just reverse it. Are you guys comfortable? Just please be careful. Just read carefully to see what's on the invoice. But if that's on the invoice, you've charged VAT incorrectly. You've got to reverse it. Next one. Indirect export. A Sandton City jewellery shop sells jewellery to a foreign visitor from his shop in Sandton City. The foreigner tells Sandton shop that he's a foreigner, he's going to take the jewellery back home with him. She needs the jewellery for a function to take place at the Sandton Convention Centre. Should the Sandton shop charge a seller VAT? And the answer is yes, you will. But they'll claim it when they go back through customs. So you must keep the invoice with you. And then, illustration 15 for export of a second-hand good. It says Mr. A is a second-hand car dealer, buys an old car for 23 from a non-vendor. In March, this car sold to a car collector in Canada for 100. Mr. A is a category B VAT vendor. So what you'll do is you'll claim notional input VAT on the car. So if you look at part A, guys, you'll claim notional input VAT, 3,000 Rand. Okay. Upon exporting the goods, what are you supposed to do? You pay back the 3,000. Are you guys comfortable with that? Is that cool? Yep. So normally with second-hand goods, what you need to do is if they're over 3,000 Rand, you need to keep you ask the company for a letterhead or some form so you know that it's there. And you keep some sort of proof. They need to say, I sold the car to you for whatever. And if it's an individual, you keep the ID book and their telephone number. If it's a company, you keep the letterhead and their telephone number. If SARS comes to do a VAT audit, you sit there and you say, here, phone up the person, you can actually find out whether they actually sold it to us or not. And if it's below, and for direct exports, they need to prove that it goes across the border. There's customs duty stuff that gets given to the exporter, and they'll just give you a copy of that and you'll just keep it on your records. You'll get it back from them, yeah. Or if you're not in control of the indirect export, like with the Sandton jewellery shop, you just charge. It's not your problem. It's up to them to go claim at the border post. So if they let you take it across the border, you can initially zero rate while you're waiting. But if they want to do everything themselves, there's no zero rating. You'll have a zero rated invoice and you'll have customs documentation saying that this is how much you took across the border, which should correspond to the invoice. Okay. There's a whole lot of practice notes for that if you want inside the Act itself. But this is too much detail for you guys. But still. When you go across the border, there's standard documentation before you take stuff out. Yeah. So if it's a second-hand good, SARS just wants the money back. So you need to understand with that motor car, they would have got 3,000 Rand paid back to the OAK. So what's SARS's net cash flow? It's minus 3,000. So they say, we just want our money back so that we're in a zero position. Is that all right? So SARS just wants to be in a null position. Because for the other stuff, they collected output VAT and input VAT when they sold it. Therefore, they just want the money back, yeah. Okay. This is very funky in an exam, by the way, because what would actually end up happening in an exam, so when I do companies with you, the sales amount that you'd put into your income statement is actually 97,000 Rand, by the way, because you sold it to Canada for 100. So what do you normally put into your income statement? The ex-VAT amount. So what do you sell it for 100 including VAT? How much VAT did you charge? 3,000 Rand. So how much do you put into your income statement? 97. So these, funnily enough, are more often asked in companies questions than they're actually asked in VAT questions. And you know what the thing is, in an exam, everybody gets it wrong unless you've seen it before. So there's a whole lot of VAT adjustments that you might find. Does that make sense? Okay. But I will remind you about that when I do companies with you. And for some particular reason, for 4861 classes, it tends to get asked more often than 4862. But I don't know. Okay. Don't worry. You can read through the anti-avoidance considerations, guys, if you want to. I'm not doing it in class. I don't think it'll ever get asked, but you're welcome to. There's a little anti-avoidance example there. Next one. So just with the anti-avoidance thing, sometimes you can try set up a scheme to actually screw SARS. That just stops you from that scheme. So you guys can have a look at it. But it's not really part of your syllabus. So I just put it in there so that you know that you can't do it. Guys, accommodation now. So commercial accommodations VATable, residential accommodations exempt. Everybody comfortable with that? Okay. Now guys, if it's office or factory or whatever, that charged at 15. If you're staying in a hotel, guys, it depends. So for the room, guys, if you stay greater than 28 days, i.e. 29 days or more, that is 60% times 15%. So you actually get a lower VAT rate. If you stay for less than or equal to 28 days, that is at 15%. And then, guys, other services, okay, there you can download porno movie channels and they charge you for that. That is always at 15%. What? Includes VAT. Then it'll include VAT at 60% of. Yes. Yes, times 60%. Yeah. So it depends. Now, guys, I've got a page after this, which is with some considerations. So I just want you guys to. Thanks, John. So I just want you guys to actually just understand the other considerations. Sometimes hotels charge you for the room in its entirety, and it's all inclusive. It includes breakfast, it includes supper, everything. Guys, in that case, it's not for other services. It's just for the room, even though it includes a meal. Are you guys comfortable with that? The other thing is, guys, you can only do the 60% if you agree to stay there for at least 29 days right at the beginning. So guys, if you don't know how long you're going to be, they will charge you at 15% up to 28 days, and then on the 29th day, they will only start charging you at 60. But if you book for 2 months, what's going to happen if you book for 2 months? They'll give you 60% from day one. Are you guys comfortable? So that's on the next page. I've got it as a little bit more of a discussion with the consider this and consider this. Let's turn to the illustrations. So it says, Mr. A owns a home in Norwood, which he rents out monthly, fully furnished. Will there be any VAT on the following income or expenses? State yes or no. Guys, it's residential accommodation, yes? Exempt, huh? So if I buy the house, can I claim VAT? No. Rent I charge? No. Furniture? No. Rates and taxes? No. Electricity? No. It's all residential. Are you guys comfortable? Sorry, can I just make a comment with this as well? What happens if the Oak decides to use 20% of the house to run a business? What happens if Oak you're renting to decides to use 1 bedroom to run his business from? You're not aware of it. I've rented it out as a residential. As far as I'm concerned, it's a residential. There's no apportionment in that circumstance. Do you guys understand? It's what the lease agreement does. It's not up to you to actually go in and see whether they're running a drug den from inside. Okay, and you should actually be charging them for a commercial property. Do you guys understand where I'm coming from? Okay. Next one. It says, number 1, Mr. A stayed for 10 days and was charged 10 for the room only. It's 10 days, therefore what's VAT at? 15%. 4,000 on meals, also at 15%. 2, Mr. B stayed for 30 days and was charged 1,000 Rand a day. He initially booked for 21 days but stayed longer. First 28 days is at 15%. The last 2 days are at 60% of 15%. Is that all right? 3, Mr. C stayed for 30 days. The company booked him in for 30 days when making the reservation. Meals separately charged at 12,000. So the room is at 60% times 15, and the meals are at 15. And then it says Mr. D paid 45, won 1,500 a day for 30 days. His company booked him in for 2 months, and this was the first month of a 2-month stay. The normal room fee was 1,000 per day, but the company requested all laundry and meals to be included in the fee. The hotel bought him an all-inclusive fee of 1,500 a day. It's all-inclusive. It's for the room, times 60% times 15. Are you guys comfortable with that? So that's there. rental of commercial property, what's going to happen with rental of commercial property? You claim that. Okay. The only one that's different is number 6, residence for the managing director of an advertising agency. That's not commercial property. What is that? That's residential. So office block, factory, retail selling space, warehousing space, there's going to be VAT charged. Guys, land rented out to an education institution for student parking. Guys, the landlord is not an educational institution. He'll charge. They just can't claim. Are you guys comfortable? So the landlord will charge. Yeah. Yes. If amounts include VAT times 15 over 115, if amounts exclude VAT times 15%. Okay. Next. Mixed commercial and residential. So this is the thing that they like to give in exams. So this is quite common in an exam. So, guys, so it says a new company is registered and buys a building for 5.7 million. The building has shops on the ground and first floor levels. Expected monthly rentals from these shops is expected to be 200,000 a month. There are 4 floors of residential accommodation. Expected rentals are expected to be 300,000 a month. SARS has agreed that where applicable, a 40% VAT input apportionment will be applied. All amounts include VAT. So guys, I'm going to do this a little bit later, but I'm just going to discuss this with you, and then I'll discuss it with you after the break again. So I've never traded before. Is that all right? So what do? I go to SARS and I say, listen, I need to register as a VAT vendor. Here's my budget. I think it's going to be 200,000 rands worth of commercial rentals and 300,000 rands worth of residential rentals. Now, what SARS will do, unless you ask otherwise, they will work out a VAT input apportionment percentage based on your budget. Does everybody understand that? So in this case, they say 200,000 taxable supplies divided by 500,000 in total from your budget. It hasn't happened yet. And they'll give you a 40% to start off with. When I do changes in use after the break, at the end of the year, you're going to see what actually happened, and you adjust your 40% if it moves by more than 10%. Does everybody understand that? So we initially use a budget, and then after that, what do we use? Whatever actually happens. Are you guys comfortable with that? But I'm going to do that in more detail. Do you understand this? Okay? And normally in a question, the way that the Act works, it says we use sales to do this. Okay? But if you go and ask SARS, they will give you another basis sometimes. So if you are in a question, you normally use sales, okay, if they don't tell you what the percentage is. Or they might actually do it on number of units. They'll say you entered into a special agreement with SARS, and SARS does it on number of units or something along those lines. So the general rule is sales unless otherwise stated. But the assumption is you know that it's sales. Is that okay? So often this is the question, and I'll say this is the budget you submitted to SARS. So I didn't need to tell you it was 40%. You could have just taken it and worked out that it was 40%. Are you guys comfortable? Carrying on, it says the following is the income and expenses of the company with an explanation of the VAT treatment for each line item. So residential accommodation income of 300,000, what are you going to do with it? It's exempt. Shop rental income of 200. There's VAT on it. It's a shop, commercial rental. Purchase of the building for 5.7. Claim input of what percent? 40%, because it's 40% VATable based on your budget. Security for the whole building is paid to a security firm who is a VAT vendor, 40%. Refurbishment of a shop costing 40. It's a shop. What is a shop used for? VAT. Therefore, claim 100% of that. Refurbishment of a flat. What is that used for? Residential accommodation. Nothing. Are you guys comfortable with this? Does this make sense? So things that are multi-use, 40%. Things that are only exempt. Things that are VATable, 100% VATable. Are you guys comfortable with that? So cool. Yep. That you just treat it as residential, yeah. Okay, so that's fair. Okay, so let's go back. You guys comfortable with this? Okay, fixed property now. Sure, this is one that gets screwed up very, very badly in practice. So let's go for it. So guys, this is not what the Act says. This is just like a decision process that I've always found useful to explain to people. So first thing I would always do is say, am I a property dealer or not a property dealer? Because if you're a property dealer, it's your trading stock, and what happens with trading stock? It's vatable. Does that make sense? So you're a property dealer, everything's going to be vatable. It doesn't matter whether it's residential or commercial or anything like that. Guys, just as a matter of interest, what happens with transfer duty? When do you charge transfer duty? When there's no VAT. So what happens if you buy something from a property developer? Do you have to pay transfer duty? No, you don't. Why? Because there's VAT. So when they say no transfer duty, save thousands or save millions, technically they're treating you as if you're a dumb shit that doesn't know what you're doing. Because what they're basically saying is there is no transfer duty because we've charged VAT at 15%. And why don't you pay VAT at 15% rather than transfer duty at 8%, you dumb shit? So generally, when I look in like the Sunday newspapers and they've got a property and they say that, I always think of that as an insult to people. You are paying 15%, not 8%, or whatever it would be for transfer duty. Are you guys comfortable with that? Okay, so that's number one. Guys, property dealer, everything's VAT. Not a property dealer. You're going to have to say, is it residential? Is it commercial? What's going to happen? Residential, exempt. Commercial, there might be VAT. Are you guys comfortable with that? So guys, just let me explain what happens now. Okay. Once upon a time, there was an oak that lived in Uppington. So I'm under the bought from a vendor column. And can you see it says VAT is levied on a payments basis? So once upon a time, there was an oak in Uppington who had his normal house that was worth 100,000 Rand. And he decided to sell his residential house to his company for like 490 million Rand. Submitted a VAT return, and SARS went and paid him like 50 million Rand as a VAT input credit. And then he just disappeared and no one could find him. And then someone went, oh shit, did we ever collect the output from that sale? And they realized that they'd screwed up. So what they do with property transactions is they want to see the money coming in before they pay it out. So they levy VAT on a payments basis. Does everybody understand that? Okay, now I just need you to understand something with the payments basis. If there's a mortgage bond in the house, technically the oak is paid when the mortgage bond goes through. Does everybody understand? So normally if there's a mortgage bond in the question, all the VAT is calculated when the mortgage bond is registered. If there's no mortgage bond and you're paying it off in installments, you'll pay it off in installments. Are you guys comfortable with that? But I'm going to show you stuff now. And it's only when you become entitled to the money. So what happens if someone puts a deposit down? Depends whether the banks approve the mortgage bond or not. So I put the deposit down, no VAT, because I'm still waiting for a bond. Bank approves the bond, then I can account for the VAT. Does that make sense? Okay. Bought from a non-vendor, guys, it depends whether it's new or second-hand. If it's new, tough shit for you. Can't claim notional input VAT on second-hand goods. On new goods, sorry. And if it's a second-hand building, transfer duty paid, claim notional input VAT, second-hand goods purchased, can only claim VAT on registration in deeds registry when transfer duty is paid. Now guys, I'm not really that phased with these things because you're going to see I'm going to give you a sheet and you're going to highlight all of these on a sheet. So you're not going to have to learn this stuff off by heart. You're just going to have to actually go to the appropriate tag, okay? And I want you to bring your books next week and all of the level 3s I'm going to tag with you. Is that okay? Just to show you how to tag properly and do everything. So I haven't handed out the sheet with you today. So if you can, please bring your books next week. We will tag all of the level 3s because there's no way you're remembering that shit. Okay, and matter of fact, it's in 3 separate sections. So you'll see that parts of it get taken from 3 separate places. So I'm going to show you how to tag all of this stuff. Guys comfortable with this? Okay. Now, I know that people think that this is easy. In an exam, this is the most common thing that gets asked. So what I've done is I've gone and done just about one of everything inside the examples. And the examples do look difficult, but you're going to see when you start doing your TATs, there's a shitload of fixed property transactions. As a matter of fact, I would say that there's no way you're not going to have a fixed property transaction at some stage this year, and maybe in your class test and in your year-end exam. Okay, so let's start with the first one. It says, for the following 3 properties, assess the VAT treatment. Residential house bought from a property dealer. VAT charged. Can you claim it? No. 2, factory bought from a vendor who is not a property dealer, from another vendor who is not a property dealer. So what happens? Guys? Not a property dealer, so is there VAT? No. But there is transfer duty. And then what do you get to claim? Notional input VAT. So you pay transfer duty and then there's VAT that you get to claim notional input VAT. And 3, use factory bought from a vendor who is not a property dealer, from a non-vendor who is not a property dealer. Okay. Guys, not a property dealer, second-hand good, transfer duty, and notional input VAT can be claimed. Are you guys comfortable with that? Okay. So that's there. Next one. Sorry, these get very, very difficult. Next one, guys. It says a property dealer sold residential property to a company that was not a property dealer. You charge VAT, you can't claim input. Comfortable. A property dealer sold residential property to another property dealer to resell. Claim input, charge output, but what basis does it get done on, vendor to vendor? Only when it gets paid. Are you guys comfortable? Next one, a property dealer sold residential property to a property dealer who intends to use the property to house employees. Now, understand that it's a property dealer, but what is the property dealer going to use it for? Residential accommodation. So the guy that sells it, you charge VAT. The guy that buys it, can you claim VAT? No, you can't, because what is it being used for? Residential accommodation, which is an exempt supply. Next one. It says company A sells a factory to company B, both are VAT vendors, neither are property dealers. It's a vendor to vendor, so what are you going to do it on? Payments basis. But there's VAT, but on payments. Class 6. A company E sells a factory to company F for 1710. Both companies are VAT vendors. Purchased property will be transferred into the buyer's name. Neither company are property dealers. Sorry, at the end of 15 months, the property will be transferred into the buyer's name. Neither companies are property dealers. So guys, the purchase is 115,000 Rand a month for 15 months. Do you guys see that? So what's going to happen? Every month, that's on the payment. Are you guys comfortable with that? Says company G is a VAT vendor, sold a residential property to another VAT vendor. Neither are property dealers. I'm selling a residential house. I'm not a property dealer. Do I charge VAT? No. And the guy that buys it from me can't claim that. Next one. A non-vendor sells a second-hand factory to a VAT vendor. Claim notional input VAT, but only once it's transferred and it has been paid. So the transfer has to go through and you have to have made the payment. Only then can you claim all the notional input VAT. Next one, a non-vendor sells a new building to a vendor. No VAT charge, no VAT input because it's a new building. So you know what you've got to do. You've got to walk in, drop your rods, piss in the corner, say it's now second hand, and then buy it. Okay, sorry, I'm being practical here. Okay. Next one, 10. Land was sold to a non-vendor in June. Payment was in 2 installments in June and August. Half in June, half in August. Is that all right? Okay, because it's a vendor selling it. The fact that it's a non-vendor buying it's irrelevant. You account for output VAT as and when the payment is made to you. Okay. Next one. It says 17.4. A vendor acquires a commercial property from a non-vendor for 1.5. Assume the transfer is paid on 1 April when the property was registered in the name of A, was 75. The house is paid for 2 equal installments of 250 on 1 Feb and 1 June. No other amounts are paid in the current year. 1 million is still outstanding. What can be claimed as VAT inputs, guys? Now, guys, I've got there. It's a vendor acquires a commercial property from a non-vendor. So there's no VAT. So there's transfer duty. Comfortable? So in your question, you say you will pay transfer duty. And then what can you claim? Notional input. But because it's a second-hand good, what do you need to have taking place, guys? You need to have payment and registration. So in this question, when was the first installment made? 1 Feb. Do you guys see that? Has registration gone through yet? So it's been paid. They say in the question that registration goes through in April. So now I've paid 250 and I've registered it. Now I can claim 250,000 times 15 over 115. And each time there's a payment, I will claim a little bit more. Is that all right? So if it's vendor to vendor, it's just payments basis. If it's non-vendor to vendor, notional input VAT, it has to be registered and you have to have paid. So anything you pay before the date of registration, no VAT. But the moment you register, whatever's been paid, you're going to work out the VAT on it at that point in time. Next one. It says a factory is sold between VAT vendors for 5 million. What are the VAT implications if a bond is registered for 5 million? Now, guys, if a bond is registered, has the person been paid for it? Guys? He's been paid. The bank gives you 5 million, you give him 5 million, he's been paid for the building. So, guys, that you account for VAT immediately. When the bond is done, you can claim all the VAT because technically you paid 5 million for it. Does that make sense, guys? It says no bond is registered. Finance for the sale is provided by the seller. Amounts of 100 are paid monthly for 60 months. What are you going to do with that? You can only claim it as and when the payment takes place. Does this make sense, guys? Okay. Sorry, they're more funky shit. It says A Limited and B Limited are both VAT vendors. Neither is a property developer. Both are registered for VAT. A Limited bought a commercial building for 2 million, including VAT from B. On 2 Feb, a contract was signed and 100,000 deposit was paid. The deal was subject to a bond being approved by the bank. The bank approved finance on 5 March, and the property is registered on 17 May. So what you do, guys, is when the 100 is paid, the sale is not certain. Does everybody understand? So there's no VAT at that point in time. When the bank approves the bond, what happens to the sale? It's approved, it's certain. So when are you going to account for the VAT? You're going to say, whatever's been paid up until now, I haven't claimed VAT on. Now the bond's been approved, I'm going to claim for all the VAT at that point in time. Are you guys comfortable with that? And then whatever's still outstanding, when the bond goes through, the bond is as if you've paid everything. So whatever you still haven't claimed, you'll claim when the bond goes through. Does that make sense? Is that cool? They like that in exams, by the way. Oh, with this one, with the previous one. So with this one, I've got a bond. So you get to claim everything. And then the other one, it's paid off in installments. With this one, it was subject to a suspensive condition. So you need to, sorry, resolutive condition. So you can only account for that when that condition is fulfilled. Is that all right? Carrying on. Sorry, there's a question called Wallace in the 4862 TUTS. And people look at it and they look at the things and they just change one word each time. It's an old exam question. And like the whole solution changes. And like people are going, but can't see the difference. It's because of these resolutive conditions and when the bond got approved. And are you guys comfortable? Okay. Next one. Insurance and assurance. So let's go. Next one. Okay. So here's how it works. So guys, insurance, what happens? It depends on whether it's short-term or life. So short-term stuff, guys, you can claim VAT input. I've got VAT on my house and I've got VAT on my car, that insurance policy, I can claim input. Guys, life assurance, dread disease, disability, and also endowment policies. If you want to put endowment policies, although I've never seen you need to put an endowment policy into an exam. Anything that's long-term, the assurance side of things, investment side, no VAT. It's exempt. It's a financial service. Okay? Short-term insurance, you claim. Now, on payouts, guys, life, dread, disease, disability, because it was exempt when I paid it, there's no VAT when it gets paid out. Are you guys comfortable with that? Is that cool? By the way, from a company perspective, you can decide on whether it's going to be taxable or not, by the way. Inside policies now, you actually just agree on the tax treatment. So if you decide that you're not going to pay income tax on the life assurance policy, it's in the contract and you won't get a deduction, but they won't treat it as income tax when you take it out. Or if you want the deduction, they'll charge it as income tax when it comes out. It's not part of your syllabus, by the way. But if you're doing a life insurance policy for a company, the broker will say, what do you want? To claim tax deductions or not? And you actually put it into the policy itself. Guys, comfortable with this? And then, guys, just with insurance company payouts, okay, I just need you to understand, if they replace the car, you're in no different position. So it's a VAT neutral situation. So it says, guys, if the insurance company replace the assets over there where I'm busy moving the thing, no VAT. I'm in the same position. They've replaced it. Guys, motor car or entertainment asset, VAT input denied, no VAT charged. But any other asset that's paid out as part of insurance claim, there'll be normal VAT. What happens if they say that cash gets stolen? Funnily enough, insurance is a deemed supply, so there is VAT on that cash amount, by the way. Because this is a deemed supply, it's not actually a supply. So there is actually no supply of anything here. Does everybody understand? So this is actually part of Section 8 of the Act. So it's actually a deemed supply. So there is no supply, but SARS says for our purposes, we're going to treat it as a supply. Therefore, if you do see cash being stolen, there's VAT on when they pay you out for the cash that's been stolen as well. It's a deemed supply. Are you guys comfortable with this? Okay, so that's why at the bottom, guys, consideration in money times 15 over 1 and 5. They've got special rules for insurance. Okay, guys, so illustrations. Motor car bought for 2 to 8, no input VAT claims. Insurance payment you received of 171. No inputs, therefore no output. 2. The canteen was burnt down with furniture costing 570. No input VAT was claimed on acquisition, as input VAT claims are denied for the provision of entertainment. No inputs, no output. So it's a normal rule. Machine destroyed in the fire. The machine was replaced by the insurance company. No VAT. If they replace the asset, there's no VAT. 4. Trading stock was stolen from a car that cost 10,000. A 17-1 payment was received from the insurance company. It's input VAT are claimed on the trading stock. I'm going to charge output VAT when I get it back. Happy. A million life insurance, equipment was used 30% for the purpose of making taxable supplies. I'm going to get back to this one later. But just note that you can claim 30% on insurance claims. I'm going to do something after the break that I'm going to explain that in more detail with. A million life insurance, exempt. Million disability, exempt. Key man policy, number 8, exempt. Okay. A company car drives through the wall of a factory owner and the insurance company pays the factory owner 20,000 for damages. Can I just explain something? So let me actually use something that you'll remember. Okay. Imagine that one night this drunk judge decides to actually crash through your wall in Bryanston. Okay. Do you remember the story? Okay. Now guys, I need you to understand whose insurance policy is it? the drivers. Whose wall do they fix? Yours. Where does the output VAT go? To you or to the driver? It's the driver, huh? So this is a deemed supply. So even though you don't get paid, you still need to account for output VAT. Let me say that again. Even though you don't get paid, you still need to account for output VAT when you damage somebody else's property. Is that all right? I've only seen him do it once. Everybody got it wrong in the exam. But you understand? Because the thing is, you seem to think that I got paid for it, therefore I need to account for output VAT. That's not how it works. It's the policyholder that always accounts for the output VAT. Is that all right? Okay. Then I've got an insurance company paid up 30 for the theft of classroom equipment from an educational institution. No input VAT was claimed. Therefore, no output is charged. Are you guys comfortable with that? So it's there. Guys comfortable with this? Okay, the last two are straightforward. Okay, next one. Leases. Oh. Guys, you can go through the next one as well. It's not difficult. Sorry, that 18.3, I've got the discussion of it. The 18.3 example is the one where you just need to make sure you know it goes to the policyholder, not to the person who gets paid. Okay. 19, leases. Okay. So it depends. We start in this top right-hand corner, guys. So there are two types of agreements. So guys, installment credits and rental. Now, in FINAC, you've done finance leases and stuff like that. So a finance lease is treated as an installment credit agreement for VAT purposes. You need to understand that there's a definition. It's called installment credit agreements, and a finance lease is included in an installment credit agreement, as is a suspensive sale, as is a hire purchase agreement, as is all of that stuff. If it is a finance lease, guys, what do? You claim the VAT up front. Okay. If it is not a finance lease or installment credit agreement, rental agreements, when do you claim for VAT? Only when payment is made. Are you guys comfortable? So it's got all the rules inside there with value of supply and everything. But again, remember, I'm going to get you to tag it. So you don't need to learn the stuff off by heart. It'll be there in your book. You just need to know where to find it. Okay. So this is a bit easier to understand. So I just put this in. So generally, guys, installment credits. If it's a motor car entertainment asset, input VAT denied. Any other assets, claim VAT up front. It's a rental agreement. It's on each lease installment. Are you guys comfortable with that? And then, guys, please just understand. Can you see it says value of supply is open market value? It's a lease agreement. There isn't actually a selling price inside the agreement. Huh? In a lease agreement, it doesn't say what the selling price is because it's not an agreement of sale. So what do we use for it? Open market value. Are you guys comfortable with that? Is that cool? And then time of supply, earlier dates of payments or when the goods are delivered. Guys comfortable with this? Okay. So it says a motor car was leased in terms of a rental agreement for 5,000 Rand a month. Can you claim that, guys? No, it's a supply of the motor car. Input VAT denied. Just because it's a rental agreement doesn't mean you claim VAT on the payment. It says a fax machine was leased in terms of rent agreement for 575. That one you can claim VAT on. Okay, guys, please be careful in questions because they tell you it's a monthly payment and they tell you and it's a 2 monthly VAT return and you need to go 2 times 575 times 50, another 115. So you'll see it so often. So just watch out for monthly payments. Okay, because you'll see, and another asset was bought at the beginning of the other month, therefore it's only times 1, not times by 2. When we do some touch, you'll see. Guys, next one. A microwave in the staff kitchen, what happens? No input VAT, therefore no. It's input VAT denied, it's entertainment. Monthly rental for offices, you can claim, no problem. And And the last one, monthly rental for a factory. The owner of the factory is not a VAT vendor. I don't get a VAT invoice. I can't claim. Even though it's a rental amount, I cannot claim because I do not get a VAT invoice. Are you guys comfortable with that? Okay, next one. Guys, you can go through this. This is not difficult. Guys, there's a least discussion question. Guys, I'm going to come back to this example when we go through and we tag books next week, okay? And I'll show you how to structure each of the individual solutions for discussion. Is that okay? It's pointless you learning shit off by heart. You just need to tag your book properly and you'll see how all of the points are there. The one thing I just want to make through, just put out to you is that the one thing I can't get you to tag is interest in a lease question. So if there's ever interest involved, you need to say that it's an exempt financial service. Is that all right? So it's the one thing I can't get you to tag, but you'll see that. Next one. Bad debts, guys. Sale in SA, what is it going to be? VAT. And export data, how much VAT? Zero rated. And staff loan, exempt financial service. So, in the examples, a trade debtors account needs to be written off as a bad debt. There's VAT. Staff loan made, no VAT. It's exempt. Goods were exported to an overseas customer, no VAT on the bad debt write-off because it was zero rated. And then goods were exported to an overseas customer. There was a sale of, was an indirect export and VAT was charged in the sale. 228 written off as a bad debt. Okay. You can only claim it's an indirect. You guys comfortable? VAT was charged. I never got the documentation. Therefore, I can claim it. Are you guys comfortable with it? Okay. Next one, guys, provision for bad debts. Do you think you can claim VAT on a provision for bad debts? They like asking this for discussion. Can you claim VAT on a provision for bad debts? So you go back to the normal VAT rule. There needs to be a supply of goods or services by a vendor. So provision for bad debts, is there a supply? No. Goods or services? No. Therefore, no VAT on a provision. Are you guys comfortable with that? Okay. Transfer of debts, guys. It depends on whether it's on a recourse or non-recourseable basis. Now, guys, if I buy debts, please just understand that I'm trading in debtors. Is that all right? So it's my trading stock, so there's going to be VAT. If I can't give the debt back, I can claim the bad debt. If I can give the debt back, then they'll claim the bad debt, not me. Are you guys comfortable with that? Do you understand what I'm saying? Certain people factor their debtors. It's either on a recourse basis or a non-recourse basis. Recourse means if I can't collect it, I give it back to you and you give me my money back. A non-recourse basis is, tough shit. I've bought it. If I can't collect it, it's my problem. If it's my problem, it's my bad debt. Therefore, I can claim the input VAT on the bad debt. If I can give it back, it's not mine, it's someone else's. Is that all right, guys? Debts between 100% owned enterprises, guys. There's a rule that says that if you both enterprises are 100% owned, they can't have the output, you don't get the input, or vice versa. Are you guys comfortable with that? I'm going to do it in a little bit more detail now. Okay, next one. All right, you guys can go through that. Bad debts recovered, guys, just works the reverse way around. It's an output, huh? Does that make sense? I wrote off the bad debt, I claimed input VAT, now I get the debt back, I have to account for output. Next one. Fringe benefits. After the break, I'm going to do fringe benefits. Overpayments, guys. Guys, if someone overpays me, I've got 4 months to refund them. If I do not refund them within 4 months, I count for output VAT. When I eventually pay them back, I count for input. So it says, example, sell for 150 on 10 Jan, paid to 150 on 15 Feb. Okay. Refund on 27 November. So the way it works, guys, is on 15 Feb, guys, I got 1,000 Rand too much. Everybody happy? So what SARS says is you've got 4 months to refund it. If you choose not to refund it, you need to account for output. So how much was overpaid, guys? 1,000. When do we need to account for the VAT? June return. Feb, March, April, May, June, 4 months later. And if they eventually catch on that you didn't refund them, when you eventually make the refund, what are you going to do? Have input. Are you guys comfortable with this? Okay. So basically what it does is it says when someone overpays you, if you don't refund within 4 months, 4 months after they overpay you, you need to account for output VAT. If eventually you do refund them, you get the output back as input VAT. You guys comfortable? I'm not going through the illustrations. You guys, it's straightforward. Next one. Goods not paid within 12 months. So what it says is, I buy goods and I choose not to pay for them. So I get to claim VAT now. Does everybody understand that? Is that cool? If I haven't paid within 12 months, what do I need to do? Give the VAT back. Now there's a timing issue here, and it is always a mistake in an exam. So I just wanted to show you the timing issue. So it says here, okay, example, buy stock for 23,015 Jan, monthly VAT vendor, paid 5,750, have never paid the remaining 17,100. So guys, claim the inputs in the 2009 return. Okay. Now guys, if I bought it in January, why am I doing output 13 months down the line? Because the section says goods not paid within 12 months. When do I claim the VAT return? In the VAT return. Which VAT return do I claim it in? End of Jan. And when is it more than 12 months down the line? 1 Feb 2010. Does everybody understand that? So please just remember the timing of supply here is in the 13th month of the VAT return, not the 12th month. Even though the section says goods not paid for within 12 months, the timing is in month 13 because you've got to go more than 12 months down the line. So you've got to go into 13 months when you do it. So anything you do not pay, you guys comfortable with this? Okay. And then guys, there's a special rule for connected persons. If it's connected persons, you don't need to do any adjustments. The guy that gets the bad debt doesn't claim for the bad debt. The guy that hasn't paid doesn't make the adjustment. So remember I said I'd come back to it when I did it in the connected person thing. So connected persons, you do nothing for. You just leave it. Next one. Sorry, connected persons. Okay. So connected persons. Vendor to vendor, normal rules. Does that make sense? So vendor to vendor, just do the normal stuff. I charge, he claims, it's fun. SARS is happy. Non-vendor to vendor is actually second-hand goods rules. Does everybody understand? Now I just want to actually point out that the anti-avoidance is in the second-hand goods rules section. So what's the rule for second-hand goods? Notional input VAT claimed, but only once you've paid for it, and it's limited to the lesser of market value or amount paid. So because it's lesser of amount paid or open market value, what happens? Where's SARS's risk here? I'm giving them input, but I didn't get output. Correct? So by saying lesser of cost or market value, I've got the anti-avoidance built in. Everybody happy with that? So where's SARS's risk? Paying too much. So how do they limit their risk? Lesser of cost or open market value. So vendor to non-vendor. That's the opposite way around. So where's SARS's risk here? The vendor charges too much or too little? Can the input person claim? So in a connected person transaction, where's the incentive for the VAT vendor company? Do they want to charge VAT or not? They don't really want to charge VAT because the other company is not going to be able to claim it. So if second-hand goods is non-vendor to vendor and it's lesser of cost or open market value, what do you think the rule is when it's vendor to non-vendor? It's not lesser, it's greater of cost or open market value. Does that make sense? Because that will mitigate the risk. Are you guys comfortable with that? So let's take us. Imagine we are VAT exempt, and we've got a company that's got a photocopy machine in it that's worth R1 million. I don't want to sell it for R1 million because I'm going to have to pay 150,000 rands worth of output VAT to SARS. So what do? I say, look, I own the company 100%, so I'm going to sell the photocopier for R1, and then there'll be 15 cents worth of VAT. What does this section do? Yes, it's R1 in the invoice, but it's greater of actual market value or the amount in the transaction. So VAT will be on the bigger amount. Do you guys understand? So connected persons is very easy. Vendor to vendor, nothing. It's just normal transaction. Non-vendor to vendor, second-hand goods rules, lesser of for anti-avoidance. And then vendor to non-vendor is greater of. Okay. You guys comfortable with that? And then again, just with the time of supply, again, all of this stuff I'm going to tag for you, so just need to know where to find it. Okay, last diagram, and then I'm going to give you a break. Diagram 25, transport. Okay. So this is pretty much easy. Guys, let's start in the top left-hand corner. It says the transport of fare-paying passengers from inside South Africa to a location outside SA is zero rated. Happy? It's an export. You're exporting human beings. Okay, it's that microbus from South Africa to Zim. The transport of fare-paying passengers by road or rail is an exempt supply. I did that last week. Below that, the transport of fare-paying passengers by air between destinations within SA is VATable. So local air is VATable. Okay. This side now, so the top right-hand corner. It says the transport of fare-paying passengers from a location outside SA to a location inside SA, zero rated. You're importing people, zero rated. Transport of fare-paying passengers from location inside South Africa to a location inside South Africa is zero rated if it's part of an international flight. So if you're going Joburg to Cape Town to Rio, the local part is part of your international flight. Yeah. And the transport of goods is always VATable within SA. Obviously, exporting outside SA, it'll be zero rated. Are you guys comfortable with this? Okay. Is that cool? Okay. And then guys, just at the bottom here, to get the exemption for transport by road or rail, the supplier must be an operator of the vehicle in which the people are transporting be commercially responsible for the transportation of passengers. Can I just tell you what they sometimes do in an exam? They say, Deloitte is having a out-of-town conference, so they hire a microbus for use of their staff to take them to the conference. That is not your business. You can still claim VAT in it, even though it's transport. You understand where I'm coming from? So when you look at the exemptions over here, please, it's only for transport operators. That is your business. If it's not your business, the sections aren't going to apply to you. Are you guys comfortable with that? I'm not going to go through the examples. The examples are straightforward. Okay, can we take a break for 20? And then I'm going to start off with the really shitty stuff after the break. So 20 minutes time.